Hi everyone. In this video, I'm going to debrief Q's of chapter number 2 from ACCA Study Hub related to conceptual framework. So let's look into the first Q's. IASB uses conceptual framework for financial reporting to assist in developing new standards. Which of the following is not covered by conceptual framework? They're asking which of the following is not covered by conceptual framework. Option A, format of financial statement. Option B, objective of financial statement. Option C, measurement basis. Option D, elements of financial statement. The answer is option A. The format of financial statement is not covered in conceptual framework. The format of financial statement is covered in IAS 1, not in conceptual framework. Objective of financial statement is covered in conceptual framework. Measurement basis, that is how an asset should be measured in SOFP, is covered in conceptual framework, and we have discussed that in a previous part of conceptual framework. In SOFP, asset will be recorded using historical cost method. It will also be recorded using current value method. So measurement basis is covered in conceptual framework. So that is not the answer. Objective of financial statement is also covered in conceptual framework. And elements of financial statement is also covered in conceptual framework. What do you mean by elements? Asset, liability, equity, expense, or income. In one of my previous video related to conceptual framework, which is already uploaded in this YouTube channel, we have discussed the elements of financial statement in chapter number 2 when we discuss conceptual framework, and we have learned the definition of asset, liability, equity, expense, and income, and that is covered in conceptual framework. And the question is asking which of the following is not covered in conceptual framework. The format of financial statement is not covered in conceptual framework. As I already mentioned first time itself, the format of financial statement is covered in IAS 1. International Accounting Standard 1 deals with format of financial statement, not conceptual framework. So we are confirming that. Going to question number 2. It's a very interesting question which has been asked one time in your examination. And most of the students have committed mistake while solving this question number 2. So read the question number 2. An item meets definition of an asset in accordance with conceptual framework for financial reporting. What additional criteria must be met for asset to be recognized in financial statement? They're asking about recognition part. Now, in one of my videos on conceptual framework, I have mentioned about recognition criteria. And elements will be recognized in financial statement if it meets 3 criteria. What are the 3 criteria? 1, it should provide useful information. So recognition of an element that is an asset, a liability, or an equity, or an expense, or an income will be recognized in SOFP or SOPL if it provides useful information, if it provides relevant information, if it provides faithful representation. We have discussed this in one of the earliest videos in my YouTube channel. So now let's look into the answer. An item meets the definition of an asset in accordance with conceptual framework. What additional criteria must be met for the asset to be recognized in financial statement? Any future economic benefit with the asset must be probable. That is the definition of an asset. They're asking what additional criteria should be met to record this asset. Asset has a cost or value that can be measured reliably. That is also correct. That is a recognition criteria. That is the definition of an asset. The right associated with items are controlled by the entity. That is also definition of an asset. But that is not the additional criteria. Recognizing it provide useful information. That is our answer to record any element, to record an asset, to record a liability, to record an equity, to record an expense, to record an income. It should first meet the definition of that particular asset, liability, equity, expense, or income, and it should provide useful information, relevant information, and faithful representation. So, other than the definition, what additional criteria an item meets definition of an asset will be recorded. So, the definition of asset we have already learned. Asset is an economic resource controlled by the entity. So, option A, future economic benefit, is definitely definition. Cost should be measured reliably. Rights should be controlled by the entity. All of that are actually the definition. Other than the definition, what additional criteria must be met? That is useful information, relevant information, and faithful representation. So option D is the answer. It provides information that is useful to the users. Now, the third one, which is very pretty much simple question, which of the following is underlying assumption in IFRS conceptual framework for financial reporting? Accruals, reliability, going concern, and relevance. That is pretty much straightforward. Going concern is an underlying assumption. And this question number 4, we have already discussed in my earlier video, part number 5, the historical cost and current cost. It's a past question paper and it's already discussed in one of my previous videos. So I think it was, I'm just skipping this or simply pressing this. It was, you can already look into that. It's option B, 320,000 and 384,000, I guess. Now, the fifth one, comparability is identified as an enhancing qualitative characteristics in IFRS conceptual framework for financial reporting. Which of the following does not improve comparability? Restating financial statement of previous year when there has been a change of accounting policy. Restating actually improves comparability. That is why we are actually restating. So that is not the answer. The question is asking which of the following does not improve comparability. So restating definitely improve comparability. So that is not the answer. Prohibiting changes of accounting policy unless required by IFRS or to give more relevant and reliable information that also increases comparability. We have learned in chapter number 4, IAS 8 changes in accounting policy, accounting estimate, and prior period error. Accounting policy can only be changed if it results in relevant or better presentation and it is required by IFRS. Why that rule? Because it increases comparability. If you're simply changing from one year to another, it affects comparability. So prohibiting changes of accounting policy unless criteria of IAS 8 are met, it actually increases comparability. So the question is which of the following does not improve comparability? So B is not the answer. Disclosing discontinued operation also improves comparability. We have learned in IFRS 5 non-current asset held for sale and discontinued operation, the cash flows as well as the profit from discontinuing operation should be shown separately so that shareholders will be able to compare the financial statement with previous year and they will also get an idea of what is going to happen in the future as well. So disclosing discontinuing operation actually improves comparability. The question is which of the following does not improve? So A, B, C actually improves comparability. So D does not improve comparability. What is it? Applying an entity's current policy to a transaction which an entity has not engaged in before does not improve comparability. So now we can see that the result is 100% correct. All our answers has been correct. I hope you have understood the question practice from chapter number 2, Qs. I'll be quite soon uploading one more video on conceptual framework, which is the objective type revision question practice from ACCA Study Hub itself. So please do subscribe to this channel. All the best for your upcoming ACCA FR examination.